Hello, everyone, and welcome back to our educational series, Stock Investing 101. In today's video, we'll be diving into an important topic: financial risk in stock investing. Our today's lesson has four objectives. First, we will be discussing what is financial risk. Second, why it is important to understand financial risk. Third, type of financial risk. Fourth is how to mitigate risk. By the end of this video, you'll have a better understanding of how to assess and manage financial risk to make informed investment decisions. Time to gear up for the investing world. Let's start with: what is financial risk? When you invest, there is always a possibility of loss or decrease in the value of an investment due to various factors such as changes in market conditions, economic downturns, changes in interest rates, currency fluctuations, or the failure of the company to perform as expected. Investors must carefully consider and assess the financial risks associated with each investment before deciding. Most people think risk and reward work equally, but it's untrue in investing. Risky investments are not always more rewarding. Always believe in business than the stock price. If a business does well, the stock follows. Warren Buffett's thoughts on risk: don't try and drive a 9,800-pound truck over a bridge that says it's, capacity, 10,000 pounds. But go down the road a little bit and find one that says capacity, 15,000 pounds. Why is it important to understand the risk? Understanding financial risk related to your investment is essential for several reasons. 1. Know your risk tolerance. Risk tolerance and capacity are necessary factors to consider when investing. Your risk tolerance determines the level of volatility and uncertainty you are comfortable with, while your risk capacity considers your financial situation and investment timeline. Several personal factors, including age, influence risk tolerance. As individuals get closer to retirement, they may become more conservative in their investment approach and have lower risk tolerance. 2. Reduces stress. Understanding financial risk and taking appropriate steps to mitigate it can help to reduce the stress and uncertainty associated with investing. With financial education, you will feel more confident in your investment decisions and be better equipped to confront market fluctuations. 3. Maximizes returns. You can maximize the potential returns by proactively managing financial risk. For example, diversification, spreading your investments across different assets and industries, can help reduce the overall risk of your portfolio. 4. Helps you make informed decisions. Understanding financial risk allows you to make informed investment decisions by comparing the potential risks and rewards associated with each investment. For example, conservative, low risk, balanced, medium risk, and aggressive growth, high risk, portfolio. Growth versus income stocks. Stock versus ETF versus mutual funds versus bonds. By assessing and managing financial risk, you can increase the chances of achieving your investment goals and financial security. Let's understand the type of risks. Types of risks. There are two main types of risk in the stock market. The first is systematic risk. Second is unsystematic risk. Let's first discuss systematic risk and its types. Systematic risk refers to the type of risk that is caused by external factors that are beyond the control of a company. It is also known as market risk or non-diversifiable risk and impacts the entire market segment. For example, imagine in the year 2050, due to increased global warming, the world decided to ban non-renewable oil products. This decision can pose a risk to the entire oil and gas industry. This type of risk is caused by external factors beyond any specific company's or individual's control, affecting all investments in the same sector. Types of systematic risk. Market risk. Market risk results from investors behaving similarly or following a herd mentality. This means that they are influenced by the actions of others and the trend of the market, causing security prices to move in the same direction. For example, if a few big blue chips are going down and other investors feel negative and follow this trend, even well-performing stocks will experience a decrease in their share prices. Market risk constitutes almost 2/3 of total systematic risk. Therefore, systematic risk is also called market risk. Interest rate risk, risk due to change in repo rate or interest rates, as it would affect the credit cycles in the market. Mainly, it impacts fixed income securities since the prices of bonds have an inverse relationship with the interest rate. But the overall impact can be seen on securities also. Inflation risk, risk due to a rise in prices of commodities or a fall in purchasing power of people, which would affect the buying decision of consumers. Political risk, risk due to any government intervention or political mishaps in the country affecting the market. The second type of risk is unsystematic risk. Unsystematic risk, also known as specific risk, refers to risks that are specific to a particular company or industry, rather than the entire market. Examples of unsystematic risk include financial risk, business risk, industry-specific risk, regulatory risk, operational risk, and competition risk. Types of unsystematic risk. Financial risk, the company has massive debt and cannot meet its financial obligations. Business risk, risk is associated with a particular company, such as poor management, labor strikes, etc. Industry-specific risk, this type of risk is related to a particular industry, such as changes in market demand, technological advancements, or new entrants in the market. For example, Netflix and streaming services pose a risk for movie theaters. Regulatory risk, changes in laws, regulations, and policies can affect a company's financial performance. For example, an additional tax on luxury items or expensive cars can impact sales. Operational risk, this refers to the risk associated with the day-to-day operations of a company, such as supply chain disruptions, technology failures, or human errors. Competition risk, increased competition can lead to lower prices, reduced market share, and decreased profitability. The main difference between systematic risk and unsystematic risk is that systematic risk is a type of risk that is inherent in the entire market or market segment and cannot be diversified away, while unsystematic risk is a type of risk that is specific to a particular company or industry and can be reduced through diversification. Systematic risk affects the overall market and is caused by macroeconomic factors, such as interest rates and inflation, while the unsystematic risk is caused by company-specific factors, such as management changes or product failures. Next is, how to reduce risk. First, think about, what is the biggest risk in stock market? The biggest risk of every investor is losing money. Now, the second question that comes to mind is, why do we lose money? If we know why we lose money, we can stop doing the activities or practicing the behavior which is responsible for losing money. Sounds simple, right? Here are some of the reasons we lose money. Short-term orientation, make impulsive decisions based on market fluctuations. Emotions of fear and greed, make irrational decisions, for example, panic selling. Rich quick mindset, invest in speculative stocks without conducting research. Wrong stocks, invest in overvalued or have poor fundamentals. Wrong timing, sell in recession, buy at the peak. Now, if we can focus on the techniques and strategies that can help us not to lose money, we can reduce the risk. So our next challenge is to find out how we can reduce the risk of losing money. When attempting to mitigate risk in the stock market, there are two primary methods to consider. 1. Decrease the likelihood of experiencing losses. 2. Limit the amount of monetary loss in the event of a loss. Here are several strategies to help achieve these objectives. First is diversification. By spreading your investments across multiple asset classes, sectors, and geographical locations, you can minimize the impact of losses in one particular area or sector. For example, diversifying in index funds, mutual funds, ETFs, etc., can reduce the exposure to numerous risks in the market. You can also consider investing in low-risk securities, such as bonds or treasury bills, as a part of your portfolio. Second is avoid market timing. Trying to time the market by buying and selling based on short-term price movements is risky. Instead, focus on time in the market with long-term investment plans. Third is dollar cost averaging, or systematic asset allocation. It is one of the most successful strategies for creating long-term wealth, which requires consistency and discipline. This involves investing a fixed amount of money regularly. For example, investing X amount of money monthly regardless of the everyday market conditions. Fourth is do your research. You must do due diligence based on your investment goals and age. You can also consider a professional financial advisor who can help you assess your risk tolerance and create a diversified portfolio that fits your objectives. Fifth is setting realistic expectations, although you may receive some income from dividends and capital gains. But investing in the stock market is not a career that typically generates income in the early stages of investment. It is uncommon for individuals to make a living solely through full-time investing unless they are a trader. It is crucial to focus on growing the capital you have rather than relying on immediate 10 times returns. Sixth is the margin of safety. The idea behind the margin of safety strategy is that if you buy a stock at a significant discount to its intrinsic value, you will have a built-in cushion that can allow you to make mistakes in your analysis and still make money. It's time to summarize the tutorial. The key takeaways from this lesson are the following. 1. Define financial risk. Explore the concept of financial risk and understand its significance in investment and financial decision-making. 2. Understand the importance of financial risk. Learn why it is crucial to have a comprehensive understanding of financial risk. 3. Explore types of financial risk. Identify different categories of financial risk. 4. Mitigate financial risk. Discover strategies and techniques to mitigate financial risk. Learn about diversification, risk management tools, asset allocation, and other approaches to minimize the potential impact of financial risk on investment portfolios. Thank you for watching. We hope this video helped you understand financial risks. Please share in the comments section what you found most valuable about the video. If you enjoyed the content, please give us a thumbs up and consider subscribing to our channel for more educational content on investing.